Hey everyone, welcome. Today we're going to dive into a really crucial part of any company's financial health, its current assets. We're going to break down the three main building blocks, cash, accounts receivable, and inventory, to show you what they really tell you about a business. But before we get into the nitty-gritty definitions, I want to ask you a question that gets right to the heart of why this all matters. How liquid is your business? Or, to put it another way, how easily can it pay its bills that are due, like, right now? The answer, it turns out, is hiding in plain sight in its current assets. All right, first things first, let's get on the same page with a clear definition. What exactly are we talking about when we say current assets? Simply put, current assets are all the resources a business has that it expects to either turn into cold, hard cash or use up completely within the next year. You can kind of think of them as your company's short-term fuel tank. So, let's start with the first building block. It's the most liquid, the most straightforward asset of them all, cash. Now, it sounds simple, right? But it's worth taking a second to clarify exactly what counts as cash on the books.
Yeah, so when we see cash on a balance sheet, it's not just the bills in the cash register. It's the grand total of all your money that's ready to go at a moment's notice. So that's the physical cash, the money in your business checking account, and any other funds you can get your hands on, like, immediately.
Let's make this super practical. Imagine a small shop. They've got $500 in the till, $4,000 in their checking account, and another $1,000 stashed in a business savings account. To get the total cash asset, you literally just add them all up.
And boom, that gives us a total cash asset of $5,500. This is the first and easiest piece of our puzzle. It's the most liquid part, the money you can use today. So far, so good.
Okay, on to our next block, which is a little less tangible than a stack of cash. This is accounts receivable, and this is all about the money that your business is owed for work it has already done.
Accounts receivable, you'll often see it shortened to just AR, is basically the sum of all your unpaid customer invoices. You've delivered the product, you've performed the service, and now you're just waiting for that money to hit the bank. It's a current asset because you fully expect to collect that cash pretty soon, definitely within the year. So if you go through and add up all the outstanding invoices from your customers, in this case we have 3 of them, you get what's called gross accounts receivable. Here it's $4,000. But, and this is a really big but, that's not the whole story. It's usually not the number that makes it to the final balance sheet. Okay, this is where things get more realistic. Businesses are smart. They know that unfortunately, not every single dollar you bill is going to get paid. So to be more honest, they create something called an allowance for doubtful accounts. It's basically an educated guess of how much money they probably won't be able to collect. When you subtract that allowance from the gross AR, you get the net AR, which is a much more conservative and frankly truthful number. So in our example, with a $200 allowance for those potentially flaky customers, the net AR that actually gets recorded on the balance sheet is $3,800. This gives a way more accurate picture. And it's also a key health indicator. If you see AR growing way faster than sales, that could be a huge red flag that a company is having trouble collecting the money it's owed. We've covered the cash you have and the cash that's on its way. Let's move on to our final block, which is all about the value that's tied up in actual physical stuff. Inventory. Now this is absolutely crucial, so listen up. Inventory is valued at what it cost the business to get it, not what they hope to sell it for. This is a fundamental rule in accounting called the cost principle, and it stops companies from inflating their assets based on wishful thinking about future sales.
Let's go back to our clothing store. Imagine their entire stock of shirts cost them $5,000 to buy from their suppliers. Then you add in the $3,000 cost for all their pants and $2,000 for the jackets. You just add it all up to get your total inventory value.
And there you have it, a total inventory value of $10,000. Now that's a pretty significant asset for sure, but it's also the least liquid of the 3 we've talked about. A really high inventory number means a lot of cash is just sitting on shelves, not doing anything. And it carries risk too. What if that stuff goes out of style, or you have to sell it at a huge discount? All right, we've looked at each of the 3 blocks on their own: cash, accounts receivable, and inventory. Now for the fun part. Let's stack them up and see what the final picture looks like when we put them all together on the balance sheet. So in the current assets section of a balance sheet, you'll almost always see these items listed in order of liquidity. That just means how quickly they could be turned back into cash. So of course, cash is always first, then comes net accounts receivable, because you expect to collect it soon, and finally inventory, because you still have to actually sell it. And here's where we get our grand total. You add up the cash, the net AR, and the inventory, and you get our big number. Total current assets of $19,300. This single number gives a really powerful snapshot of the resources the company has ready to go to operate in the near future. So we have this number, $19,300. But so what? What does it really tell us? Why did we go through all that? Why is understanding this calculation so critical for anyone looking at a business? Well, it all comes back to that word we started with, liquidity. Your total current assets are the #1 indicator of a company's ability to handle its short-term bills. You know, things like payroll, rent, paying its suppliers on time. This right here, this is the bottom line. It's the core idea. You compare your current assets to your current liabilities, which are just the bills you have to pay within a year. If your assets are bigger than your liabilities, you're probably in a healthy spot. You can breathe easy. But if it's the other way around, well, that's when a business might be heading for a cash crunch. It's that simple and that important. So let's just do a super quick recap to make sure this all sticks. Cash, that's the money you can spend today. Accounts receivable, that's the money that's on its way to you. And inventory, that's the value of all the stuff you're waiting to sell to get more cash. See, together, these three things tell a really powerful story about a business's health and how efficiently it's running. They show you its ability to handle tough times. So, the question I'll leave you with is this. Think about your own business or a company you follow. What story are its current assets telling?